Assalamualaikum and good morning everyone. My name is Muhammad Zaki bin Mohia and my group member are Anwar Atif bin Abu Kide and Muhammad Aiman Sufyan bin Amran. Today we will present the topic 10, which is custom clearance of import and export cargo. First, we need to know what is customs clearance. Custom clearance is the act of taking goods through the custom authority to facilitate the movement of cargo into a country and outside the country, which is import and export. Also, the custom clearance means a document issued by the custom authority to a shipper, indicating that all the duties have been paid and the shipper's good is cleared for export. Custom clearance will involve with the preparation and submission of documentation that required to facilitate the export or import into the country. Then represent the client during the custom inspection, assessment, payment of duty and retrieval of goods from custom after clearance along with the document. Next, let us take a look at documentation. Any commercial cargo, whether it is for import or export, requires custom clearance. Simply put, this means that businesses engaged in exporting to the country and importing goods from the country needs to clear specified custom barrier as outlined by the government. And at the screen is the list of documents required for export custom clearance and the list of documents required for import custom clearance. The custom clearance process typically involves preparing documents that may be submitted electronically or physically with the consignment. This will help the concerned authorities to calculate the tax and duties that will be levied on the cargo. The type of document required for custom clearance usually depend on the type of good being shipped. It may also vary depending on the country of origin and the destination of the cargo. However, as a thumb rule, there are a set of general documents that most businesses need to comply with when importing or exporting goods. And for the custom duty, it is a kind of indirect tax that is imposed on the both exported and imported goods and services. The tax imposed on the import of goods is known as the import duty, and the tax imposed on the export of goods is known as export duty. The government charges this tax during the export or import of goods and services to raise the money for shield the domestic establishment from the competitor of other country. Let's take a look at India. The government of India brought a major change in the tax system of the nation. They introduced the GST, Good and Service Tax, a new tax collection system that is a destination-based tax which implies the consumer are liable to pay when they use any good and the services. Before, the tax system was complex. Multiple tax such as service tax, value-added tax, state tax, central excise, and more tax that were imposed on various goods and services. Under GST, this multiple tax has been replaced by just one tax, that is GST. GST has three categories: CGST, Central Good and Service Tax; SGST, State Good and Service Tax; and IGST, Integrated Goods and Service Tax. Both CGST and SGST are applicable on intra-state transaction, whereas the IGST is applicable on the interstate transaction. The custom duty is now replaced by IGST, which means that instead of the custom duty, IGST tax is applicable, along with the other applicable custom duties on every import and export of goods and services. Now, let's proceed with the custom clearance of imported goods. A bill of entry is a statement of the nature and value of goods to be imported or exported, prepared by the shipper and presented to a custom house. The importer clearing the goods for domestic consumption has to file a bill of entry in 4 copies. Original and duplicate are meant for the custom, third copy for the importer, and the fourth copy is for the bank. If the goods are cleared through the EDI system, no formal bill of entry is filed as it generated in the computer system, but the importer required to file a cargo declaration having prescribed particular required for processing of entry for the custom clearance. For the import clearance process, they are using the EDI procedure. Today, a number of major port and international airports are linked with CHA shipping line and their representative through EDI. Electronic processing of the document, which is speed up the custom clearance process. In the EDI system, the importer has to file a cargo declaration giving the necessary detail of the cargo. The computer system then generates a bill of exchange electronically. The assessing officer will examine the consignment-related detail on the screen. The system will perform all the calculations such as determine the rate of duty relevant for a particular HS code. In case the goods are accepted under some exemption notice, the system will determine the extent of exemption and calculate the duty accordingly. The system also automatically apply the relevant exchange rate for a calculation. In case the assessing officer has any query, he can raise it through the system and receive a reply through the service center. The EDI system will first generate and print the assessed bill of exchange based on which the goods are examined. After assessing officer clear the goods, the final bill of exchange will print. It is also possible for importer to inquire about the status of the document submitted by them through the EDI system. For this, a facility of telephone inquiry is provided at certain major customs stations.
Thank you to the previous presenter. Now I will be moving on to the clearance of export cargo. In India, every consignment that leaving the India shores by sea, air or land has to undergo a prescribed procedure of custom clearance. This can be done by the exporter himself or by the help of his or her CHA. The first one is registration procedure. In the registration procedure, every exporter must have a permanent account number or PAN that is given by the relevant income tax authority. Against PAN, the Director General of Foreign Trade (DGFT) issues the Business Identification Number (BIN) to the exporter. The BIN is sent electronically to the custom by the DGFT. The exporting company must open a current account in a designated bank and register the authorized foreign exchange dealer code, through which export proceeds will be realized and export incentive credited. All airline shipping lines, airports, and ports handling export-import cargo must also register with the customs system. These registrations are useful for correlating the various details of consignment in case of EDI-based custom clearance. Exporter must availing export promotion scheme must also get the license or DEEC books registered with the customs station from where the export goods are to be cleared. After the registration procedure, there are processing of shipping bills. A shipping bill is required for custom clearance of cargo being exported by sea or air. Similarly, for the bill of export, which is required for the cargo that is being exported through land transportation. Both shipping bills and bill of export has different copies for export dutiable goods and duty-free goods, and for goods eligible for duty drawbacks. There are manual procedure and EDI procedure. Manual procedure is the old procedure that need the exporter to submit the documents along with the shipping bills to the custom house. Next, we go to the electronic interchange process or EDI procedure. There are 5 stages of this procedure. In stage 1, the exporter or CHA fills the declaration in the prescribed format through the Custom Service Center or IT system. The exporter or CHA verifies the data as per the checklist generated by the system. If the data is correct, the system will generate a shipping bill number endorsed on the printed checklist, and this is given back to the exporter or CHA. In case of dutiable items, the exporter pay the duty along with TR6 challenge generated by the system. Next, in the stage 2, the exporter is not given any copy of shipping bill. The goods are allowed to enter the dock on the strength of the checklist endorsed with the shipping bill number. The exporter or the CHA submit the checklist with the original invoice packing list, GR form, ARE form, and etc. to the custom office, who verifies the document against the received goods and hands over all the original document to the shared appraiser for physical examination of the cargo. On the stage 3, the custom officer designated by the shared appraiser conduct a physical examination of cargo, and he or she will be enter their observation into the system and return all the original document to the shared appraiser. In the stage 4, the shared appraiser is satisfied with the report submitted by the custom officer regarding the quantity and description declared by the exporter. They may issue the lab export order. The shipping bill is generated by the system in 2 copies only after the lab export order is given by the custom. 1 copy is for the custom and the second copy is for the exporter. 1 more copy, that is a third copy, is generated after the submission of Export General Manifest (EGM). It is mandatory for the shipping lines to electronically submit the shipping bill-wise EGM to the custom within 7 days of sailing ship. Next, on the last stage, the exporter or CHA submit the exporter copy of shipping bills duly signed by the dock appraiser to the preventive officer for allowing the cargo to be loaded on board the ship. In case of containerized cargo, the preventive officer supervises the stuffing of container at the dock. The officer also ensures that the container is properly sealed. He or she enters the container number and seals the number and endorses the shipper copy of shipping bill before allowing the container to be loaded on the board of the ship. The officer may also stamp the ship on board seal on the shipping bill. Next is custom valuation. Custom valuation is defined as the custom procedure applied to determine the custom value of imported goods. If the rate of duty is ad valorem, the custom value is essential to determine the duty to be paid on the imported goods. Next is the method of the valuation. In the method of valuation, we can see an importer brings goods to India from foreign country. They should declare the value of goods in the bill of export. For the purpose of the valuation, the Customs Department considered transaction value of goods as the basis of calculation of duties subject to certain terms and conditions. Transaction value is the price actually paid or payable by importer for the goods when sold for export to India. If the customs authorities have any doubt regarding the truthfulness of the value declared by the importer, they can evaluate the goods in the following order, which is the first one is comparison with transaction value of identical goods under the Rule of 5 of Custom Valuation Rules 1988, comparison with transaction of similar goods under Rule 6, then deductive value method, which is based on the sale price in the importing country under Rule 7, or compute value method based on the cost of the material, cost of manufacturing, and profit in the country of origin of goods under Rule 7A. Or the last method is fallback method, which is based on the previous method with a flexibility under Rule 8. After that, factors of valuation. There are two types factors of valuation. The first one is dutiable factors, which include commission and brokerage, cost of containers and packing, the value of various goods and service supplied free of charge or at reduced cost. It does not include the price paid or payable. Next, the non-dutiable factors such as interest charge for deferred payment, post-importation charge such as inland transportation charge, installation and commissioning charge. Now we look at the type of custom duties. Under the Custom Tariff Act 1975, it defines the rates of custom duty under the types of custom duty. The first one is the basic custom duty. This duty is levied as the percentage of value determined under Section 14 Clause 1. The range of applicable rates varies between 5% to 30% for different commodities. The government has imposed an education cease on imported goods with effect from 9 July 2004 at the rate of 2% of aggregate duty of custom. After that, we look at the additional custom duty. The additional custom duty is also called as countervailing duty, CVD, as this duty is equal to excise duty levied on an identical product manufactured in India. If identical product is not manufactured in India, the base is excise duty that would be leviable if the article had been produced in India. CVD is payable on the value plus basic custom duty. A special additional duty, SAD, is levied under Section 3 Clause 1 of the Custom Tariff Act. Next, we look at the additional duty under Section 3 Clause 3. This duty is in addition to CVD, which can levied by the central government. This is to counterbalance the excise duty leviable on raw materials, component and etc., similar to those used in production of such articles. Whereas CVD is applicable to all goods, additional duty under Section 3 Clause 3 is applied only on a case-to-case basis as determined by the central government. After that, we look at the protective duty. Under the protective duty, it is imposed on those goods which are perceived to threaten the interests of Indian industry. This duty can be reduced or increased with suitable notification by Tariff Commission established under the Tariff Commission Act 1951. Fifth duties is the countervailing duties on subsidized goods. If a country is found subsidize goods for exporting to India, the central government can impose the countervailing duty equivalent to the amount of such subsidy. In case it is not possible to ascertain the extent of subsidy, a provisional duty is imposed till the amount of subsidy is ascertained. The second last is anti-dumping duty on a dumped article. There are instances when the foreign manufacturer start exporting its product to India at very low price compared to the price in their domestic market. It is such a tactics that referred to as a dumping tactic, which is used either to get rid of unsold or excessive stock or to cause injury to the domestic industry in India. To nullify the impact of dumping, the central government can impose anti-dumping duty equivalent to the margin of dumping. This duty is compatible with WTO agreement, which permit imposition such if the act of dumping is proven. However, this duty can impose only if an Indian industry produce similar article. The last one is safeguard duty. This duty can be imposed by the central government if it convinced that certain goods are being imported into India in large quantities and are causing or may cause serious injury to the domestic industry. Now we move to the objective of various types of custom duty. It is the objective which is the reason for the duties it is levied. The first one is to collect the revenue from import and export trade. Next, to create the level playing field in the Indian market for international and domestic manufacturers to compete with each other on equal and fair terms. The third one, to protect the Indian industry from unfair business practices. The fourth, to generate the revenue for a social cause, which is, for example, the education cease contributes toward the education sectors in India. The fifth, to prevent the banned item from entering the country and ensuring the safety and security of the country is not compromised. And the last one is to ensure that India conforms to all international conventions and complies with the various international obligations such as WTO agreements. Next is the harmonized system. The harmonized commodity description and coding system, or it is better known as the harmonized system or HS, is one of the most successful instruments developed by the World Customs Organization. There are 121 contracting parties to the HS Convention who use it as the basis for their custom tariff and international trade statistics. HS is called as the language of international trade as it is used in many areas such as trade policies, rule of origin, the monitoring of controlled goods, internal taxation, transport tariff, statistics, quota control, and economic studies and analysis. It had been said in March 2006 more than 200 countries and economic or custom unions that account for almost 98% of the world trade will use the SH. Next, the importance of HS nomenclature. It can be highlighted by the fact that it has enabled the harmonization of custom and trade procedure and non-documentary trade data interchange. The HS code employs the same numeric code on the worldwide basis for a given commodity. This helps reduction in the international trading cost. There are other benefits of this system, which is accuracy in calculation of custom duty, fewer disputes between shipper and custom authorities, reduction in custom clearance time, reduction in transaction costs, easier trade negotiation, simplification of trade data analysis, better supply chain security. Therefore, it can be concluded that in the era of computerization, HS coding has significantly helped international trade. Considering the increasing volume of export and import across the world, HS nomenclature is proving to be a blessing for all stakeholders in the international trade. Now, I will be giving the presentation to the next presenter.
Next topic, I will present about carnet. It's like your passport for goods. It's that simple thing about you have your personal passport allow you to travel around the world, clearing customs or immigration and going in and going out of many countries with the same idea of the ATA carnet, but for your commercial goods. A carnet or ATA carnet is an international customs and temporary export-import document. It is used to clean customs in 87 countries and territories without paying duties and import taxes on merchandise that will be re-exported within 12 months. Carnets are also known as merchandise passports or passport for goods. There are two types of carnet, ATA and TECRO AIT. TECRO AIT carnet are used for temporary imports in Taiwan, which only accept the TECRO AIT carnet. ATA carnet are used for the 87 other countries and territories that are members of the carnet system. Carnet facilitate temporary imports into foreign countries and re-importation, presenting an ATA carnet document to foreign customs. You pass duty-free and import tax-free into a carnet country for up to 1 year. Next, what merchandise is covered by carnet? Most merchandise can be listed on a carnet. Virtually all types of goods and equipment can be transported under the ATA carnet, which is commercial samples, professional equipment, tools of the trade, goods for fair and exhibition limited to 6 months. And next, what merchandise is not covered by carnet? Consumable items such as agricultural product, food, seed, fertilizer, explosive, disposable and postal traffic cannot travel under an ATA carnet. Next, this is 87 countries and territories that accept carnet system. Malaysia is one of the countries that accept carnet system. There an example document of carnet. Front green cover, holder or user and country information. The front of the green cover includes the holder, which is owner of the goods information, and lists all the ATA carnet countries. It must not be altered or amended in any way. Back green cover, carnet general list of merchandise and equipment. This list cannot be amended, but it is possible to travel with partial shipments. Next, there are yellow, white and blue certified sets, counterfoil and vouchers. Counterfoils are the control document of the holder and remain with the carnet. Vouchers are the control document of customs and are removed by customs. This is a yellow certified set counterfoil only in the US. This is the US registration of goods that will return to the US. There are no yellow voucher in a US carnet. A yellow certificate set includes an exportation counterfoil and a re-importation counterfoil. Then, white certificate set include counterfoil and vouchers are used by foreigner customs. A white certified set include a white importation counterfoil, a white importation voucher, white re-exportation counterfoil, and a white re-exportation voucher. Lastly, blue certificate set include counterfoil and voucher are used by foreigner customs to track goods that are within their borders but have not cleared customs. These goods are in transit. A blue certificate set include 2 blue transit counterfoil and 2 blue transit vouchers. Next is about US Customs 34-hour advance manifest regulation. Security lapses at various points, including US port and airport, were found to be the cause of the terrorist attack on the World Trade Center Twin Tower in New York on September 11, 2001, according to investigation. Since then, the US has adopted a strict immigration policy and a tight visa rule to ensure that a foreigner visitor credentials are verified before a visa is granted. Passengers are also thoroughly interviewed upon arrival at US airport before being allowed to enter the country. Security agencies in the United States are also concerned about the cargo that arrive in the country on board ocean carriers from around the world. Terrorists are feared to be bringing weapons and ammunition into the country via shipping container in the future. To avoid this, several measures has been taken. Effective from 2 December 2002, US Customs regulations were amended and the rule regarding 24-hour advance manifest policy was published in the Customs Federal Register. Under this requirement, manifest information must be provided 24 hours prior to a US-bound shipping container being loaded onto the vessel in a foreign port. The US-bound Customs and Border Protection (CBP) may deny the loading of high-risk cargo while the vessel is still overseas. Then, if a vessel is calling a US port directly, the rule requires all ocean carrier or non-vessel operating common carriers (NVOCC) to submit a complete cargo manifest to US Customs at least 24 hours prior to cargo loading. US Customs work with a foreign government to examine shipments that are considered high risk. As a part of compliance, ports across the world do not load message to carriers NVOCC in case of clear violation of the 24 hours rule. If the cargo description is clearly in violation of the 24-hour rule, port will issue a do not load message on this shipment. Some examples of the description considered to be a clear violation of the rule are as follows: consolidate cargo, FAK freight all kind with no other description, general merchandise, machinery, 35 pallet, various retail merchandise. Next, there are new developments in custom clearance procedures. There is a consensus among custom board as well as the trade and industry that the current custom clearance procedure is cumbersome and create bottleneck in the movement of cargo in and out of India. There have been 3 major reasons of increase in world trade. First, formation of WTO and the resultant breaking down of trade barriers. Then, application of information technology which has made the communication and transfer of information and data faster than even before. Then, investment in transportation sector such as containerization of cargo, development of air freight carriers, faster and bigger ship, superior material handling system, better port, road and rail infrastructure, and so on. These new developments have increased the volume of import and export in India. Hence, there is an urgent need for a faster custom clearance procedure. September 2001, the Custom Board approved in principle the concept of custom business process re-engineering. It is expected that there will be more impressive system appraisal for a larger number of importers or commodities than at present. Also, the best practice for custom clearance adopted by other countries on sale assessment, selective examination of cargo, and post-clearance audit for specific categories of importers are also being studied. This exercise may result in a risk management-based custom clearance mechanism with the following potential benefits. First, smooth and speedy flow of goods without hindrance. Then, minimal personal interaction between importers and departmental officer. Then, reduction in transaction costs, thereby achieving better competitiveness in world market. Then, scrutiny of larger volumes of cargo with better efficiency. Next, the International Convention on the Simplification and Harmonization of Custom Procedures, Kyoto Convention, came into force in 1974. The WCO Council adopted the revised Kyoto Convention in June 1999 as the blueprint for the modern and efficient custom procedure in the 21st century. The General Annex to the revised convention recommends the following principle that a modern custom administration should implement. First, standard simplified procedure, continuous development and improvement of custom control technique, maximum use of information technology, a partnership approach between custom and trade. Then, they are the key element within the revised Kyoto Convention to be applied by modern custom administration, which are the maximum use of automated system, risk management technique including risk assessment and selectivity of control, the use of pre-arrival information to drive programmers of selectivity, and so on. India is a signatory to the International Convention, also known as Kyoto Convention, on the Simplification and Harmonization of Custom Procedure, which came into effect on 3rd February 2006. That's all from us. Thank you for watching and listening.